International Securities Watchdog unveiling policy recommendations aimed at regulating cryptocurrencies and digital markets. The proposals from the International Organization of Securities Commissions cover things like dealing with conflicts of interest, cross-border cooperation, and the treatment of retail customers. The group wants regulators across the world to move faster on the task of regulating crypto. Joining us now is former SEC Chairman Jay Clayton. He's a CNBC contributor, non-executive chair of Apollo, an American Express board member, and a senior policy advisor at Sullivan and Cromwell. Thanks for making the time to come here. I think what's interesting here is what we've seen in terms of FTX, what we've seen with Binance, is that there are crypto operators that are headquartered elsewhere. Different rules apply out of the reach of the United States, and U.S. customers ultimately can see harm. And so this call for cross-border regulation makes sense, but it seems even more elusive, more difficult to achieve.
Well, let's try and look at it as a little bit of a positive, because as we've talked about before, crypto, let's call it a technology that enables some new products, a technology that may enable a lot of products we know to function better. Crypto has not been handled well by the industry or frankly, by the regulators on a global basis. And that we've talked about is because it emerged globally and emerged outside the financial system. So what does this report say? It says financial instruments, whether they're classified as securities or commodities, that are going to touch the retail public, that are going to be part of our ecosystem, they need to be regulated as we know well. And it's really a principles-based report. It says, look, these are the principles that should apply around the globe. And they're pretty straightforward. They're ones we know. We got to protect customer assets, segregation, conflicts, and the like. On trading, we have to have fair trading. We can't have spoofing. We can't have front running. We can't have all the things we don't like. Societal issues, AML, KYC. We got to protect money laundering, terrorist finance, all those kinds of things. And then at the end of the day, prudential, which we're all talking about with the banking crisis, and like no excess leverage, no liquidity transformation. The report says, hey, regulators around the world, you need to apply this to digital assets.
Okay, makes sense. I want to move on to another issue that is certainly or potentially impacting stocks in the stock market. We had a report earlier. There was this AI-generated image of smoke coming out of the Pentagon, fire. It moved the markets, the S&P 500, by 0.3% that day, intraday. It quickly recovered because people noticed that the AI image wasn't that good. They figured out that it was fake. But this opens up the broader question of manipulation of the markets through the use of AI. And it could have been easily somebody spoofing an account saying that we've got news that the FDA is going to approve this drug, which could move a biotech stock. It could be various things. Do you think this is on the radar of the SEC?
It is, I am certain. It should be. And let's just take a step back and watch the transformation of market dissemination or information dissemination into the marketplace. 20 years ago, what you relied on was companies posting their information with the SEC. Right now, right here in this studio, this is where information. This is where it happens. That is a huge transformation. We have instantaneous dissemination of information. That creates a new risk because you used to have a bit of a gatekeeping function when all information sort of flowed through the SEC years ago. Now it's somewhat ubiquitous. We need to look at how we can verify that. And, let's just start with where should you go for sort of trust. With companies, it's easy. It's easier. It's their website, their dissemination. When it's macro events, that's far different, and it's something that we do need to think about across the regulatory community.
Seems like a losing battle, though. Yeah. I mean, you're like
I'm an optimist.
Optimist, right?
There's got to be a way, right? If technology creates a new risk, it ought to create a new way to mitigate that risk.
But the technology probably would have to come from the platforms because they're the ones who would be responsible for it. How do you motivate them to do that?
Hopefully self-interest and hopefully regulation. Look, it doesn't always work, but what I keep asking myself is when somebody hands me something, is there some kind of watermark or the like that I can tell whether that is AI, assisted or not? That would actually be, I don't know if it's possible, but it would be incredibly valuable to me. Someone hands me something and says, hey, here's a draft. Was that AI assisted or are those your thoughts? Because I'm going to actually look at it differently. It would be very interesting to know. I don't know if it's possible, but it's something I'd like.
I want to go back to crypto for just a minute. You mentioned KYC and AML rules, anti-money laundering rules, know your client rules. Isn't the whole point of crypto to preserve anonymity for the owners of crypto, and how hard will it be if you did have rules like that in the U.S. and other countries? Would crypto just disappear because a lot of people just wouldn't want to own it because the whole point for them is to stay off the grid?
Well, going back to a new technology creating risk, but also creating opportunity, certainly there were crypto products that were designed to be anonymous and the like, and then, quite useful for nefarious activity.
Right.
Okay? But $100 bills, okay? People use $100 bills for nefarious activity. Are we going to shift from $100 bills to programmable money, where it's much easier to detect illicit activity? So both sides of this, I think the distributed ledger technology and what we've seen in stablecoin and the ability to, what I would say, just program cash so you can trace it, that's a pretty powerful technology, and may in fact change our cash economy.
And do you
especially our global cash economy?
Yeah, I just wonder, this is a global rule, this is a global governing body saying we kind of hope all the SEC and all these regulatory bodies take our lead because they should. What is the track record for other countries taking the lead from this organization, and doesn't every country kind of want to do their own thing?
The track record is what I would say is not bad on very significant issues. But what you can see is securities issued in the EU or issued in the UK, that is real. We don't regulate that. Right. What disclosure there? We're having this climate debate, right? What disclosure EU companies are required to provide is very different from the disclosure that the U.S. is required to provide. On bigger macro issues like AML, KYC, cooperation is better. On bigger issues like what I would say is manipulation and trading, cooperation is better. But it is an issue. I always say to people, you send your dollars offshore, the ability of a U.S. regulator to get those dollars back is very limited.
Right.